Welcome to the third episode of the DataSpot podcast, and in this episode, we will discuss the journey of passive funds in India. We will start with what exactly are the passive funds?
Yes, so passive funds include both ETFs and index mutual funds. Why and what are the reasons behind the rise in the passive flows in India?
Why did the net inflows in passive funds over the last 4 years amounted to rupees 4,000 billion rupees, which was almost double the active funds inflows?
You will find answers to these questions and a much detailed discussion on the passive inflows in this episode. Stay tuned.
So, ETFs and index mutual funds are classified as passive because in these kinds of funds, the fund manager does not decide what stocks or bonds or other instruments the fund will own. In a non passive or an actively managed mutual fund, the fund manager has entire discretion on what instruments to hold in the fund. Yeah. She or he can buy or sell stocks based on his or her discretion. She may choose, for example, to buy Infosys one day and sell it the next day and buy again the following week if that is what she thinks is the right thing to do. In a passively managed fund, however, the fund simply mirrors a particular index, both in terms of securities as well as their weights. This could be, for example, the Nifty or Sensex in case of India, or even a sector specific index like Bank Nifty. If the entity that constructs the index changes the constituents of that index, say some stock is replaced by another, the fund manager blindly follows that change. The fund manager cannot use his judgment to say that this particular stock change was not right.
That means that the fund manager has no active role in deciding in which stock these monies need to go. Whatever funds she or he receives directly get allotted within the stocks in that index. That is why they are termed as passive funds.
Yeah. So prima facie, passive funds seem like a bad idea, right? After all,
Mm.
why would an investor want his money to blindly follow an agency that constructs an index without a check on the investment worthiness of a stock?
But you will be surprised to know that they are growing in popularity because of many reasons. Firstly, it is low cost investment. Compare this hiring a fund manager and paying him or her for doing extensive research on what stock might give better returns in future versus just mirroring the index as it is. So obviously the latter is cheaper. The second reason is the performance. Outlook India recently published a study that compared 3 years return on active funds versus passive funds. It shows that top 28 large cap funds have an average 3-year return of 23.72%, while a Nifty based passive funds delivered 25.18% gain. Another reason is the simplicity in the product. When you compare active versus passive, it is much easier to understand what the returns will be like. Since the fund's returns would be based on some index, an investor can easily track how the index is performing. They don't have to keep track of individual stocks under an active scheme. So, from that angle, the design is simple.
Yes, you are right. You pointed out that the returns on passive funds are more than the active funds. This is not surprising considering a theory known as efficient market hypothesis. So, what does this theory tell us? It tells us that markets are efficient in the long run. This means that share markets reflect all available information and therefore that information gets into the stock price accordingly. This means that investors should not be able to outperform the market in the long run. If the market is efficient, then there would be no benefit to active investing. Passive investors would achieve a higher return in the long run due to lower cost. That's what the theory tells us. But looking at the data you just presented, it seems like it is true in reality.
Yes, possibly. And this is underlying principle can be a major reason of investing in such funds.
Yes, supporters of passive investing do bring up this point again and again to justify it. By the way, we are not here to give any kind of recommendations. Okay, so you make all the investment decisions based on your risk appetite and after consulting your financial advisor only. Also, if you are a subscriber to the India Data Hub newsletters and reports, you must have got a detailed report on passive funds last month. We will be discussing on some topics mentioned in that report today. So if you are not a member yet, then you can become a member easily. Details are in the description below.
So, before talking about the passive funds, I think it would be great to take a recap of what all took place since the inception of the mutual funds in India.
Yeah, sure.
So, the industry began in 1964 with the unit schemes of UTI. Within a couple of decades, that is by the end of 1988, UTI had rupees 67 billion AUM. Then we had non-UTI public sector mutual funds like SBI, Punjab National Bank Mutual Fund, etc. post 1987, and by 1993 the AUM had reached rupees 470 billion. So from 67 billion in 1988 to 470 billion in 1993. This journey of a sevenfold rise in just 5 years is astonishing.
Yes. And after 1993, the industry was open to private sector. The number of fund houses rose. There were foreign mutual funds coming into India, and there were also many M&As which consolidated the industry. So as of April 2023, the AUM crossed 41 trillion rupees mark. And I think this is a massive growth and remarkable story.
Yes, this also tells a lot about the industry penetration as well as the savings mobilization overall.
Yeah, with regard to savings mobilization, we can compare the growth in mutual fund AUMs with, say, bank deposits.
Yes, good idea. So the AUM as of the end of FY 2001 was rupees 0.9 trillion. As of the same date, the aggregate bank deposits amounted rupees 9 trillion. That means mutual fund AUM was close to 10% of bank deposits. You can see it in this chart. The purple bars are bank deposits and the green ones are mutual fund AUM, while the orange line shows mutual fund AUM as a percentage of bank deposits. By FY 2022, you can see that the AUM has increased to rupees 38 trillion, which is 22% of the bank deposits. So when you compare growth in mutual funds AUM and bank deposits, we can see that over the long run, mutual fund AUM has grown by 19% CAGR versus bank deposits at 15% CAGR. That shows that mutual funds are penetrating and also growing up at a faster rate than the bank deposits.
That is interesting. I think one thing that has been a catalyst was SIPs or systematic investment planning. I started my investment journey through an SIP only. A couple of decades ago, SIPs were not that common. People used to start the first investment through an RD or recurring deposit. So, at least from my personal experience, I can say that there has been an attitudinal shift.
Yes, me too. I believe SIPs kind of instills a certain kind of investment discipline.
Yes. Now, let us focus on the main topic. We drifted a bit, but I think it was a good discussion.
So we have mentioned a couple of times that the total mutual fund AUM was rupees 41.62 trillion as of April 2023. Out of those, 7 trillion is in the form of passive funds, which is roughly 16%. Let us see how it grew in popularity in the last couple of decades. As of April 2019, passive AUM was around 1.4 trillion. That means it just multiplied by nearly 5 times in the last 3 or 4 years. So that is a significant jump from where it was few years ago.
And the main driver was EPFO. Yes, the same organization that manages our provident funds. Historically, EPFO or Employees Provident Fund Organization invested in government securities of highly rated corporate bonds only. However, in 2015, it made a decision to allocate 5% of its annual flows to passive schemes of mutual funds. Over time, this allocation increased to its current level of 15%. That means 15% of your provident fund contributions go into the passive schemes and ETFs especially. In FY16, EPFOs invested 66 billion rupees in ETFs, but in FY22, it invested around 436 billion rupees. So that is 6 to 7 times growth in just 6 years.
Not only EPFO, but even individuals have also contributed to passive funds. So it is usually believed that institutional investors largely invest in passive mutual funds, which is true. The share of corporates is around 80%, But you cannot miss the other 20%, which comes from the individuals like you and me. So before COVID, individuals contributed to around 10% of the total passive AUM, but now it has spiked to 20%.
And between 2019 and 2023, nearly 25% of the increase in passive AUM is due to investments by individuals. Usually, most individuals invest in active equity funds, but now passive funds have become the second largest category of individual folios after equity funds.
But it is not that this rise in passive mutual funds has come at the cost of active equity funds. So individuals have continued investing in equity funds too. This means individuals do not see passive funds as some alternative to equity funds.
Yeah, but what we can see is that there is a reduction in debt funds and hybrid funds. And I think this reduction could be due to falling interest rates post COVID. Also, I think stock market was creating new highs after COVID. Plus, we saw a lot of attraction towards financial markets, especially from the younger generation. The rise in demat accounts also tell us everything.
But the question is whether this trend will continue or not.
Yeah, there are multiple contradictory theories around it. So, in the USA, we have seen that around 40% of total AUM comprises of passive funds. Many experts in US say that this is cyclical in nature. This means that there are periods where active will be higher than passive and vice versa. We can also loosely call it as mean reversion. But some believe that passive will continue to rise up to say 80 to 90% in the future. We have already discussed the reasons for the rising popularity of passive funds. So those things will continue and give push to more passive funds. Now, coming to India, the share of passive is hardly 16% now, but I feel this can increase considerably in the near future.
Yeah, compared to US, our share is still low. But what might happen if the majority, like 90% of the AUM are passive? Will it be good for the market or not?
So, recently, there has been a growing voice against the proliferation of passive funds. Some say that such a rise in passive funds means that investors will not pay attention to individual stocks because people will look at the index, right? So, is a particular company financially strong or not, or is it adhering to corporate governance norms or not, etc.? These things will matter, obviously, but in aggregate or at index level, and not that much as it is tracked today for individual stocks.
So that makes me think of the role of indices in general. The concept of index was started to give a sense of how a bunch of stocks or the overall market is going. So it is designed in a way where the stocks with higher market capitalization will have a higher weight. That way, it gives a picture of the trend in traded value as well as volume. So it was never created to become an underlying asset for passive funds. Therefore, as you have mentioned that due to the nature of the passive funds, the funds will give better returns if the overall index that it tracks performs well. So it doesn't matter in aggregate if the couple of stocks perform poorly, right?
Bang on. That means if the net inflows are positive, the market cap of stocks in the index will go up, which means that there is a potential that the prices can theoretically go up exponentially. Or in case things got reversed, the prices can go down too. Therefore, this itself goes against the principles of efficient market hypothesis. It is not the information about the stocks that is driving the stock prices. It is the flow of funds. I read one line that kind of opened my eyes, which was passive's willingness to buy securities is not a function of fundamentals or valuations. It is a function of flows.
So if we compare the mechanism of active versus passive, the active funds analyze companies' future earnings and prospects and decides if they are overvalued or undervalued. Those managers, in a way, allocate capital to those companies which are relatively cheaper than their fundamentals and have good prospects compared to those having poor prospects and expensive related to their fundamentals. But with passive funds rising, the dynamic might get changed, at least based on these theories.
Yes, absolutely. By the way, everything that we are discussing over last 1 minute or so is based on different theories, and we are just brainstorming here and not giving any kind of forecast.
Yeah, so in all, there are some issues with passive funds if their proportion increases. But it continues to be a cheaper, simpler, and easier way to invest as of today. So that is not going to change.
Yes, people say that only regulations, either directly or indirectly, can stop them. Let us see. We are not in a position to comment on it, but I'm glad that we had this discussion on this podcast. At least a few people will be aware of these things now.
Yes, fingers crossed. That's it for this episode. Do like, share, and subscribe this channel for more such interesting topics, and do follow India Data Hub and both of us on social media. All the details are mentioned in the description below. Thank
Thank
you.
you.